Good morning, everybody.
Good morning, ma'am.
Good morning.
Good morning, ma'am.
Okay, so I think I had posted one activity for next Friday. Did you all
Yes,
receive
ma'am.
it? So
Yes,
it will be a
Yes,
part of
ma'am.
MBA activity. So it will carry 10 marks of your assignment. In that, 5 marks will be for this activity. Okay. So I think I have only planned your groups. So anything you want to add or you
Ma'am,
want to
there's a
alter?
problem in the group.
Okay, tell me.
Ma'am, you have mentioned Ranveer Dosai, but he is not in our class.
Tanvi Zara is from your class only, no? In my attendance register,
No,
yeah, he's your maybe he's your is in your class.
in our
he's the repeater,
class.
I guess. Yeah.
Yeah.
Oh, okay, sorry. Thank you.
Oh. So how do you want to what is your you have any ideas to add on to the activity that we can carry in a better way?
Ma'am, do we need to present the topic? One topic each?
Yeah, I have given you the topic, right?
Yes, ma'am. Yes, ma'am.
So based on that topic, you will have to present it in the form of posters or in the form of PPTs. But since we are on all on digital, the better way will be the PPTs. You can bring your PPTs and you can explain. All that is very simple. I think wealth management, engineering, asset management, all topics are it's all it's more or less very simple. You can just Google down and you can explain the concepts and what you have understood, what will be the advantages, merits. You can conclude with the slide.
Okay.
Where is this wealth management applied? In wealth management, uh, for which and all departments it will be very helpful, very essential. Whereas engineering asset management, where is it applied? Which part of the organization uses that? What are its advantages, disadvantages, right? That you can plan. Or you can bring in some case study and try to explain with the help of the case study as well. Make it as simple as it can be. Uh, that's all I can tell. Clear?
Yes, ma'am.
Okay. So since we have done with 1, 2, and fifth module, we are going to take up the ratio analysis. It's very simple module from your fourth module. So we will see the ratio analysis. I hope you have your books and pens with you, because if you're not noting down, then it will become difficult for you to solve the problems. Is it clear? So keep your books
Yes,
and
ma'am. Yes, ma'am.
pen ready with you. Can you see it? Have I shared the slide with you?
Yes,
Yes,
ma'am. Yes,
ma'am.
ma'am.
Okay. So in ratio analysis, first what no, we have done so many we have done with working capital management and in that net capital and gross capital management and all we have done, right? So finally you try to calculate the ratio. What does it signify? Okay, in anything, if you take, you have done ratio analysis, right? When you were in school or when you're in fifth or sixth or seventh standard, you have to study the ratio analysis, right? So this advantage of using the ratio, what does it, what does it infer, or what do you interpret from that result? Why do you think we need to do the ratios? What is the inference we get from the ratios? Yes, Prince, Nilesh.
Yes, ma'am. Ma'am, relation between two objects. Ma'am.
To get a relationship between two objects. And finally, when whatever two objects are comparing should have some at least one parameter similar with them, right? So then only you can bring in them with comparing these two, right? It can be in comparison of apple and oranges, it can be in the comparison of weight between apple and oranges, whatever it is, but some parameters should be same, right? Bananas, if you're measuring in dozen, and apples you're measuring in kgs, you cannot bring a comparison between these two, right? So basically a ratio analysis is a method or a process by which the relationship of items or group of items in financial statements are computed, right? Since this ratio analysis is the most important tool in our financial management, especially when we are studying or trying to bring about the connection between the current assets and current liabilities, right? So it in understanding, we have already seen how a balance sheet is made, how a journal is made, right? So when we're studying all that, we need to understand the ratio that lies between the assets and liabilities. So when we are computing them, this ratio analysis gives us a clear picture of what is it, right? So it is an important tool in our financial analysis. It is also used to interpret the financial statements. By interpreting the financial statements in terms of what? In terms of profitability, in terms of its liquidity, like the working capital, whether it has sufficient money to clear the loans or it has sufficient money to pay for the wages, how is the flow of the money within the organization, right? And also it enables us to help us to evaluate or understand the efficiency of the system, efficiency of the organization, right? So it basically it is going by these ratio analysis, we can clearly understand the picture of the business or picture of the organization, whether it is moving in the profit range or whether it's moving towards the loss range, right? So the last point, it is used to interpret the financial statements so that the strength and weakness of a firm, it has a historical performance and the current financial conditions can be determined. Any doubts in the first slide? Any doubts in the first slide? Or is any doubts in the first slide?
No, ma'am.
Okay. Because this PPT is available on the net, you can Google down and keep a copy of it. It's very helpful, and I found it very good compared to any other material. So you can please download and keep this PPT with you all. Okay. So next is the ratio. What is the definition of ratio? Ratio is a mathematical yardstick that measures the relationship between two figures or group of figures which are related to each other and are mutually interdependent. As I said, at least one parameters should be similar between these two when you're trying to bring about a comparison. It can be expressed as a pure ratio, or it can be expressed as a percentage, or as a rate. Now, when we are doing this ratio analysis, there is certain caution, when we are trying to bring about a conclusion, these points must be kept in mind. The ratio is not an end itself, right? The ratio cannot, although it helps us to give us an idea, but it cannot always help us. It is not the only tool, or it is not the only mode where we can take the last decision of the organization. They are only a means to get to know the financial position of the organization. Computing ratios does not add any ratio, any information to the available figures. So whatever ratio we get, that small value is not the end. We need to still, there is a prolonged value for that figure which we get. It only reveals the relationship in a more meaningful way, so that we can carry our further operations in a much easier way, or it helps with this ratios, we can take the next steps more effectively. Then a utility of ratios. Accounting ratios are very useful in assessing, same thing, it's very useful in assessing the financial position, profitability of an enterprise. It it lies in comparison of the ratios. Now, these ratios can be used for the following. One of the main forms is the comparison. The same enterprise, how is it performing over the period of years? When you want to bring about a comparison between two enterprise, okay, one enterprise against the industry as a whole, one enterprise against the predetermined standards. Intersegment comparison also you can make by using this ratio analysis, right? Then this ratio analysis can be broadly classified into liquidity ratios, leverage ratios, profitability ratios, and activity ratios. I want you to make a list from the balance sheet. We will be computing all these ratios. This unit is very simple. A balance sheet will be given. From the balance sheet, you just have to remember these formulas, substitute the values, and get the answer. This unit is only about that. So you should, here only you need to remember the formulas, and you need to know which formula to be substituted when, right? So have you taken down these? Ratios are classified into 4 types. One is liquidity ratios, one is capital structure or leverage ratios, profitability ratios, activity ratios. Please note down these 4 points. Have you taken down? Done? Work finished?
No, yes, ma'am.
Everybody is good taking it down? Now first we will see what is liquidity ratio. Liquidity ratio is basically the ratio on short-term financial positions of a firm and indicate the ability of the firm to meet its short-term commitments. Like how we in the working capital, when we dealt the working capital, it involves in that particular amount that is required to process your product in such a way that when material machines are required, only that small operations to make the efficient utilization of all these 3 resources in converting into product. So how that money will be utilized, that is the liquidity ratio in short-term commitments. Okay, this is also known as solvency ratios. Liquidity ratios is also known as solvency ratios. Under liquidity ratios, you have to know 2 types. One is current ratio and the other one is liquidity ratio itself or quick ratio itself or acid test ratio. Done? Now, very important first formula. Current ratio is calculated by dividing the current assets by current liabilities. Please take down this formula. Current ratio is equal to current assets by current liabilities. Usually, the current ratio should be 2:1 for the organization to operate well. Have you noted down this first formula?
Yes, ma'am.
Okay. So the next formula is what and all things should be from the balance sheet. What and all things will come under the current assets. Under the current assets, you can include inventories of raw material, work in progress, work in process, finished goods, stores, spares, sundry debtors or receivables, short-term loans, deposits and advances, cash in hand and bank, prepaid expenses, income receivables, marketable investments, short-term securities. All these, if these values are there, in some you can have finished goods, sundry debtors, short-term thing. In some, different mix and match combinations can come in your balance sheet. But in the balance sheet, these are, if these things are there from the balance sheet, you need to take all this to find out what will be your current asset. Please take down this list as well. If you have this list, when you're solving the problem, when you turn your pages, if you have this list there, then you can quickly solve your problems. Is it clear? Finished?
Yes, ma'am.
Next, we'll see what are the things that will come under the current liabilities. Current liabilities will include sundry creditors, their debtors and receivables we had here, creditors and bills payable, outstanding expenses, unclaimed dividend, advances received, income received in advance, provisions for laxation, proposed dividend, installment of loans payable within 12 months, bank overdraft, and cash credit. All these things will come under the current liabilities. Assets is that money we need to get, liabilities is that the money we need to finish the payment by the end of the period. Is it clear? So I want you to take down, these are the things that should be included in the current liabilities. Finished?
Yes, ma'am.
Yes, ma'am.
Now we'll move on with quick ratio. Quick ratio is basically the ratio that lies between the current assets and current liabilities. And then what is you can ask what is liquidity, what is current ratio? Current ratio is also current assets by current liabilities. Here quick ratio is between quick assets and current liabilities. It will be calculated as a ratio of quick assets versus current liabilities, right? So calculating by dividing the quick assets by current liabilities. Now let's see what are the things that will come under the quick assets. Now quick assets are current assets as stated earlier. Less prepaid expenses and inventories will come under the current quick assets. Is it clear? Similarly, quick liabilities are liabilities as stated earlier. Less bank overdraft, incomes received in advance. So these two and these two we have to note it down in quick assets and quick liabilities. So even see if they ask current ratio, then they will not ask quick ratio. If they ask quick ratio, then they will not ask current ratio, right? So I want you to make a note of the formula which is given here. Finished? Next will be the leverage ratio.
Yes, ma'am.
Next will be the leverage ratio or capital structure. This leverage ratio is basically the ratio that indicates the long-term solvency of the firm, like the lease paid, the investment you make for the land, all that the capital that you invest for your firm will be included in the capital structure or leverage ratios. These ratios indicate the long-term solvency of the firm and indicate the ability of the firm to meet this long-term commitments with respect to repayment of the principal on maturity or in predetermined installments at due dates, then repayment of periodic payments of interest during the period of the loan, right? So these and all comes under the leverage ratios. Under the leverage ratios, you have these are the ratios that you need to compute. What are they? Debt equity ratio, property ratio, debt to total capital ratio, interest coverage ratio, debt service coverage ratio. So with these computing these ratios, you can understand where does the organization stand by looking at their balance statement. Now in the debt, first one we will see the first ratio, debt equity ratio. Debt equity ratio is given as long term debts by the shareholders funds. Please take down this formula. Finished? You can note
Yes,
down
ma'am.
the standard value also. Next is long-term funds or loans. Long-term funds are long-term loans, whether secured or unsecured, like debentures, bonds, loans. All these comes under the long-term loans. Shareholders funds are equity shares, capital plus preference share capital, like the whatever funds that you are giving for the employees and all that will come under the shareholder funds here, right? Next is the proprietary ratio. The proprietary ratio is basically the proprietor of the organization is more will be depending upon this proprietary ratio. So proprietary ratio will be equivalent to the proprietor's funds by the total funds, or the what is the asset or what is this total value will be depending upon the will be proprietary ratio will be by finding the proprietary ratio. By having these two values, we can find out what will be the proprietary ratio, right? So it is basically the ratio of proprietary's fund by total funds or assets he possesses.
Finish, ma'am.
Finished. Like how we explained in shareholders funds, total funds are all fixed assets and all current assets. Alternatively, we can calculate proprietors funds plus long-term funds plus current liabilities, right? Now, next one is debt to total capital ratio. Debt to total capital ratio indicates what proportion of the permanent capital is with the firm, right? So it is given as long-term debt by shareholders fund plus long-term debt. This is the formula. Long-term debt by the total funds they have, that is inclusion of the shareholders fund plus long-term debt they have. Finished? Finished?
Yes, ma'am.
Next is we need to find out the interest coverage ratio. So interest coverage ratio is nothing but the debt servicing capacity of a firm is so far as the fixed interest or long term loan is concerned, that we earn earnings before the income tax period that we take, right? So that money by the interest will give us the interest coverage ratio. Is it clear? Earnings that we get before tax and after tax, both we will consider when we are calculating when we are trying to find out the profitability of the organization. That time interest coverage ratio is equal to EBIT by interest of the organization that they need to pay. Earnings before income tax. Finished? You just note it down when we are trying to calculate formula problems. Then these ratios, when you have the formulas in handpicked, you can just substitute there and get the answer. Next will be debt service coverage ratio. Debt service coverage ratio is earnings after tax plus interest plus depreciation plus other non-cash expenses. The entire thing divided by interest plus principal in installment. So please note down these formulas. Was before I wanted to show these formulas, I had a video for you to understand the subject better. Have you taken down this formula? Have you taken down this formula, boys?
Yes, ma'am. Yes, ma'am.
Boys, is this YouTube video that's been visible on your screen?
Yes, ma'am.
I wanted to show you this. Kindly have a look at this.
In this short video, we're going to introduce the performance. It involves a comparison of data, typically financial data, and the aim of ratio analysis is to use that comparison and interpretation of financial data to gain insights into how a business is performing. Ratio analysis is very widely used in business because it helps answer some key questions. For example, why is one business more profitable than another? Or why is one business less profitable than another? What kind of returns are being earned by the shareholders from their investment in the business or by a business as it invests in its projects? How solvent is a business? Is it able to pay its debts when they become due? How well does it manage its assets, particularly its working capital, such as inventories, debtors and creditors? Ratio analysis helps answer all of these questions, albeit it doesn't necessarily lead to the solutions to those questions. Ratio analysis is essentially built around financial information from the financial records of the business, and the two main sources of information that you'll typically use as you calculate ratios are the income statement, which is an historical record of the sales, the income and the costs of a business over time, and also the balance sheet, which you'll remember is a snapshot of the assets and the liabilities of a business at a particular point in time. So from the income statement, we'll draw out data such as revenues or income and sales, the cost of those sales, which enables us to calculate and look at gross profit. We look at the operating profit and the net profit or profit for the year when we're looking at profitability ratios. From the balance sheet, lots of useful information. In particular, we often look at elements within what we know as working capital, so current assets such as inventories, trade debtors, current liabilities, which of course includes amounts owed to suppliers. We look at the level of inventories. We look specifically when we're looking at efficiency of asset management at those trade receivables and payables. But also when we're looking at the financial structure of a business, we look at the bottom part of a balance sheet. We're looking at the capital, the reserves, and the amounts that are owed in the long-term liabilities of a business. What we've done is we've produced separate revision videos that show you how to calculate each of the ratios, each of which draws on information from the income statement and the balance sheet. Now, in terms of ratio analysis, the key process involved in this is firstly to gather the data. Of course, most of that will be from the financial accounts of a business. What you then do is you calculate the ratios. Having calculated the ratios, importantly, what you then need to do is to analyze and interpret the results. What's the ratio saying? And finally, and perhaps most importantly, take some action based on it. No point calculating a ratio unless, in particular, if it gives you an insight into business performance, unless you do something about it. In terms of ratios, there are quite a few of them out there. We've grouped them into three main groups. Profitability ratios. This is looking at the returns or profits earned by the business, both in terms of a proportion or percentage of revenues. So gross profit margin is gross profit divided by revenues, operating profit margin, operating profit divided by revenues. So that's a relative profitability based on revenues, but also in terms of the return that's earned on the capital employed in a business. Perhaps the most commonly used ratio there is return on capital employed. So profitability ratio is all about how a business earns returns. Liquidity ratios are all about whether the business is able to pay its way, can it pay its debts? And the two key ones there are the current ratio and the asset test ratio, which use information from the balance sheet. And thirdly, what are known as financial efficiency ratios. Here we're looking at the effectiveness of the way in which the business manages its finances. So how long does it allow customers to take before they pay their bills? Receivables days. How long does it take before it pays suppliers? Payables days. How quickly does it turn over the amount of inventory it holds in the business? And also the gearing ratio, which looks at the relative proportion of debt in the business as a proportion of the overall capital in the business. There is one more group of ratios known as shareholder ratios, which are all concerned with the returns earned by shareholders. We're not going to group those into this presentation. Who uses ratios? Well, of course, there are many different users of accounts, and therefore there are going to be many different users of the ratios based on those accounts. Lots of user groups are interested in the profitability of a business. Of course, shareholders in particular want to understand what kind of returns are being earned. But of course, if you're a competitor, you're certainly interested in the profitability ratios of your key competitors. And I guess as an employee, you're interested in what kind of returns and profits are being earned by your business. Governments will be interested in profits, particularly when it comes to understanding how much tax should be paid on those profits by businesses. Liquidity ratios also have lots of users interested in them. In particular, I would say that lenders and suppliers are particularly interested in whether a business is able to pay its debts. And that makes sense, doesn't it? If you're a supplier offering credit to a business, you want to be pretty satisfied that the business will be able to pay your invoices when they become due. Similarly, a lender like a bank would look very closely at the liquidity position of a business to make sure that the business is able to pay the interest and the capital amounts owed on a bank loan, for example. When it comes to financial efficiency, it's very similar, actually. Shareholders definitely want to make sure that the business is being run efficiently, that the capital tied up in the business is being minimized. Lenders and creditors, very, very interested in how the working capital of a business is managed. And of course, competitors will be interested to see whether a competing business is able to manage its assets more effectively, more efficiently, because that could be a source of competitive advantage. There we go, guys. That's just a brief introduction to ratio analysis, highlighting the key areas of ratios. And
students, I hope you would have a clear picture of ratio analysis would have been given by this video. In the next class, maybe we'll continue the formulas again, and maybe on Thursday's class we'll start, tomorrow's Thursday, on Friday's class we'll start, Saturday's class we'll start solving problems. Is it clear? Boys?
Yes, ma'am.
Okay, then we'll stop with this class. Baswaraj, Chandan, Neelesh and Prince. Okay. Okay, then we'll meet in the next class.
Thank you.
Ma'am, when are we